We are very, very honored and excited to have Schreiner Parker on from Rystad Energy, who's going to talk to us about Venezuela and the Latin markets and the global energy markets. But before we get into that, a couple little housekeeping items. We are coming up on tax season, believe it or not, again. And we're going to be starting to push those tax workbooks out to our CPAs. Helps us if you get your addresses updated. So if you go log into your accounts, make sure that you go to settings, check out your investing accounts. Under that investing accounts, that's where you want to update your address. We also have a tutorial video linked on the dashboard. It says updating your address if you've moved, or you just want to make sure that you have the correct address on file so that your K1 shows up crisp and complete and not with an old address on it. That helps us out, reduces the amount of churn when people get their K1s, especially when they're a little delayed. We also have the Excel sheet that we're going to be, or Google sheet that we're going to be publishing soon here with delivery estimates for all your K1s. So just wanted to get ahead of that. Brittany, any other housekeeping items before we jump in?
Nope. That was perfect. Thank you so much.
All right. Sounds great. Well, without further ado, would like to introduce Schreiner Parker from Rystad Energy. Schreiner, thank you so much for joining us. Really appreciate it.
Yeah, absolutely, Tate. Happy to be here. And I've known your colleague Mark for many, many years. And so very pleased to share some perspectives with you on Venezuela and what the implications for more of the global oil markets are. And just by way of background, introducing myself, I've been at Rystad Energy, which is a research and consulting firm with a specialization in the energy industry for over 10 years now. Our company is based in Oslo, Norway, but 35 offices around the globe. And currently I'm the lead for our emerging markets practice. So traveling all over Latin America, being in the remit there. But previous to this role, I ran our Latin American practice based out of both Mexico and Brazil, speak Spanish and Portuguese. And Venezuela is a market that we've been covering for a long time, including in my previous employer, Wood Mackenzie, when we actually were going down to Caracas in the 2010s, early 2010s, late 2000s, with PDVSA as a client who I told you in our call earlier that never paid us, but we still went. But it's an interesting scenario and it's an interesting time. And of course, people have been talking about the what if scenario in Venezuela for many years. What could happen in a regime change where this oil industry opens back up? And I think that what we have seen so far from the Trump administration has been the removal of Nicolas Maduro being a sufficient condition, or rather being a necessary condition, but not sufficient to actually see a renaissance in oil and gas production from Venezuela in any sort of short to medium time frame. Really, you can think about the U.S. assault on Venezuela and the attempt to control its oil industry as a refining and flow reallocation event rather than a classic supply shock. The lasting impact lies in the reoptimization of the U.S. Gulf Coast refining system with a limited amount of heavy crude processing and the intensification of competition in the heavy crude markets and the strategic marginalization of China within the Venezuela oil ecosystem. But I think really the timeline of the U.S.-Venezuela conflict highlights a long-term strategy that's centered on securing heavy crude supplies for the U.S. Gulf Coast refiners, which are configured to process heavy sour barrels and benefit from Venezuela's ability to deliver crude over short lead times. This is going to reduce reliance on Middle East high sulfur fuel oil for the U.S., and exports of that Venezuelan crude are expected to recover slowly toward the U.S., Europe, and India, leaving China disadvantaged while OPEC plus kind of remains defensive. That's a technical way of saying that I don't think in the immediate term the Trump administration goal is to see Venezuelan production surge to 3 million barrels, which was its historic high in terms of the production capacity that comes from Venezuela. Where we see there are kind of several issues as to why Venezuela would not be able to attain that 3 million barrels a day. They produce about 1 million barrels today. To get to that 3 million barrels a day peak that they had from the 1990s, there would be a lot of different things that are required. But mostly we're talking about investment.
And I'd just like to put that in perspective that the U.S. daily production is about 13.5 million
Correct.
barrels.
That's right.
And their previous peak was 3 million.
That's correct. Yeah.
Yeah.
So if you think of US, Saudi, and Russia all account for right around 10, US more 13, Russia a little bit under that today. But yeah, 3 million was the peak production there, and 1 million barrels today. And with a very long road that's going to require a lot of time and investment to get back up to that 3 million barrel a day mark. So in our estimate, we're thinking that you would need $53 billion of oil and gas upstream and infrastructure investment over the next 15 years just to keep the Venezuela crude production flat at 1.1 million barrels per day. We do estimate that there is an additional 300,000 barrels a day of additional supply that could be restored within the next 2 to 3 years with limited incremental spending. But going beyond that 1.4 million barrels per day level, it is possible, but would require a stable investment of 8 to 9 billion per year from 2026 to 2040. And on top of that hold flat capital, on top of the hold flat capital requirements, right? Venezuelan crude production could then recover to 2 million barrels per day by 2032 and eventually get back to that 3 million barrels per day by 2040. Some of this investment can be financed organically, right, by the national oil company PDVSA, but we would need to see 30 to 35 billion of international capital committed within the next 2 to 3 years to make the 3 million barrels per day by 2040 scenario possible. So in total, the total oil and gas capex requirement over the 26 to 2040 period to reach that target of 3 million barrels per day would be an estimated 183 billion, with your cumulative service purchases estimated 156 billion after the internal E&P operator spending is removed. So it's a massive amount of capital that would have to flow into Venezuela. And I'm not sure that the political conditions as they stand right now today are sufficient for Western oil companies, particularly American oil and gas companies, to commit that type of capital to Venezuela. And there's a few reasons for that. The first issue is within the Venezuelan constitutional change that was made by them in 2009, which prohibits foreign oil companies from owning a majority of any oil and gas asset in Venezuela. Under that 2009 constitutional reform, all foreign oil companies have to take a minority position in a joint venture with the national oil company PDVSA. Beyond that, the fiscal terms are not very enticing. They're almost like service contracts. So the return on investment for a Western oil company under the current fiscal regime that you would sign a contract under, and the current constitutional, the legality of operating in Venezuela without being able to take a majority ownership of any asset, would preclude and prohibit most of the bigger Western oil companies that we think about, Shell, Exxon, the Total, the French, would prohibit them from going there. That's the short-term issues. Of course, Chevron is there. They are present. They are operating as a minority partner to PDVSA. But what we have seen with Chevron, we expect to be the exception rather than the rule. It doesn't seem like there's a lot of appetite for U.S. major oil companies to enter Venezuela as it stands today. So you would need to see a constitutional reform that would allow for Western oil companies or foreign oil companies to be able to own a majority of any asset. And then you would have to have those fiscal terms revised to be attractive on the short term. Long-term issues here are governability and contract sanctity. And I think, Darren Woods mentioned this in his meeting with President Trump on Friday at the White House, that in the 80 years that ExxonMobil has been active in Venezuela, or was active in Venezuela, they had their assets nationalized 2 different times. So the risk, the long-term above ground risk, is still quite high. and there hasn't been a material change in the governance situation within Venezuela. Of course, the Chavistas, the PSUV party, maintains power. Delcy Rodriguez, who was Maduro's vice president, has been sworn in as the president. So there has not been a sweeping political change that has occurred either that would portend more confidence from investors as with Venezuela being a long-term play. And I think without that element of governance and without that element of contract sanctity, that complicates making an investment decision in Venezuela in the long term. So when we think about global oil markets in general, this Venezuela concern, I think, has been rather muted and is actually not really a contributor to the volatility that we've seen in oil price recently, and particularly with some gains in oil price. Structurally, we are in an oversupplied market and entering into more oversupply this year. So we expect there to be some weakness in oil price. Geopolitical events more geared toward Iran actually than to Venezuela, which was kind of already baked in a little bit, are influencing price. We've seen price move up over the last several days. And I think that has more to do with the Iranian situation. So that's something to continue to watch. But from a structural perspective, we're in a bit of a bear price scenario market with oversupply in 2026. I will say that from a macro view, if we look further out into time, we're actually structurally in a bull market if we're looking at a 10 to 15 year period where we see demand resiliency remaining. We see demand staying above the 100 million barrel per day mark for an extended period of time, maybe much longer out than previously. And we actually see a supply deficit beginning to form in the 2030s. So Venezuelan crude could become a Western counterbalance to Saudi production in the 2030s or 2040s if this investment scenario goes off. But I think as the current conditions stand, it would be tough to see that oil renaissance in Venezuela of 2 to 3 million barrels per day of production. Again, I think removing Maduro was necessary, but not sufficient.
This is excellent wisdom here. So, and this is one of the reasons why we went on to bring on an expert for our investor base is, it's very easy to just get caught up with the headlines and the sensationalism of the mainstream media. Something that we sent out last week was just a quick insight on a headline that said U.S. to, reshore 30 to 50 million barrels of sanctioned oil. And it didn't say anything in that article about how much the U.S. produces. So there's no context. It's just 30 to 50 million barrels. Oh my God, oil prices are going to collapse. It's like, and we pointed out that was between 1.8, 30 million barrels is about 1.8 of daily U.S. supply, 1.8 days of U.S. production, I should say. And 50 million would constitute less than 4 days of U.S. production. So when you put it in context, it's like, oh, okay, this isn't as big a deal. So I think, before we turn it over to Q&A to our investor base here, I think what's on everyone's mind is, a lot of you who are on the call invested in the Iron Horse deal, have invested in the Aspen Energy funds that we have hosted in the past and are potentially considering an investment in our 2026 oil and gas fund, which we're very excited about, which we're currently working on, and we'll be targeting a launch date somewhere in April. And I think what's on everyone's minds is, okay, what's happening? How long are prices going to stay low? We ticked up this week from $57 to about $62 a barrel. There's also some external demand drivers around AI and natural gas really coming in to fill that gap between, all the different renewable technologies that are much more expensive to build, like nuclear, that can fund the AI boom. What are your thoughts? And I know that you don't have a crystal ball, of course, but what are your thoughts on the geopolitics, the global oil markets, and you alluded to it in terms of a supply crunch starting to form in the 2030s, but nearer term in the next few years, what's your outlook?
Yeah, absolutely. Well, it's like Yogi Berra once said, predicting anything is difficult, but especially the future. And I think if we could predict oil price accurately every time, we'd get out of the consulting business and get into the trading business. But yeah, I think, as I mentioned, we do see a supply glut forming, this year, and expecting soft prices absent the geopolitics throughout the course of this year. Of course, OPEC's behavior in terms of unwinding their production cuts has been interesting to see now holding. It seems the OPEC is still of the mindset that they would, and the Saudis in particular, that they would rather sacrifice market share to protect price than the opposite, gain market share for lower price. And if you think about the Saudis, they balance their national budget around $80 oil. Price is very, very important for them. And maintaining that price is something that we've seen OPEC, at least over the last several years, again, sacrifice market share to protect that price. I think from a geopolitics point of view, if you look at oil, it has a very low demand elasticity, at least traditionally. And so any perceived aberration in supply can create these, spikes that we've been seeing. And I think that the Iranian thing is of interest, but again, it's somewhat muted and baked in to market expectations in the sense that Iranian crude is not flowing freely to the open market. The same with Venezuelan crude previously, right? These are both sanctioned crude producers. So the crude that was being exported from both these countries was actually feeding the black market. And really, a lot of it in Venezuela's case, of course, going to Chinese teapot refineries along the coast there. So yeah, I don't think that there's going to be, I think that the geopolitical impact of both of these is going to be rather muted and will expand the elasticity a little bit in terms of the demand for oil. And I think that the supply glut will continue to manifest. But, as we say, we are moving toward a period where we are expecting peak oil production coming from the United States in the early 2030s. The same with Brazil, the same with Guyana and Suriname, a little bit further out into the 2030s, but still the first half of that decade. So there is a call on exploration, right? And there is a need to be out doing more exploration, doing more investment into bringing production online. And that's the production that's going to be absent again in that kind of in the later 2030s, unless there is some major success in exploration, or shale is able to be replicated, shale extraction is able to be replicated in other jurisdictions outside of the United States and Argentina in a full development scenario. So softness this year, a bit of an oversupply, but moving into that structural bull market as we see supply constraint in the 2030s.
Hey, Schreiner, I've got a quick question. The next OPEC meeting, I think, is this summer. How do you see that going with, the U.S. basically controlling the production of one of its founding members?
Yeah, very interesting question, Mark. And certainly, I think Venezuela's membership in OPEC is going to come into question, and for good reason. I mean, what advantage does Venezuela have even though it's a founding member of OPEC, what advantage does Venezuela have today to submit to artificial production constraints if they're in a scenario where there is investment that's flowing in? They wouldn't want to do that. And we've seen other OPEC members recently in the last several years leave the cartel for that very reason, right? Ecuador, tired of submitting to artificial production cuts. They needed to produce the maximum they could. Angola, the same story. So I think Venezuela's membership in OPEC is where the political situation normalizes in Venezuela to the point where you could see that level of investment that I just discussed coming in. Then I think it would be very difficult to maintain OPEC membership and still realize that renaissance of production that you're looking for. I think that the OPEC meeting will probably have more. There will probably be more designed on what happens in Iran, if anything. And if we see some type of regime change in Iran, and then those barrels could very quickly come back to the market, then that makes a material difference. Iran is much more well-positioned to send barrels to the market when sanctions are lifted, rather than Venezuela, which has had such degradation in the oil patch that there's no way to return production to meaningful numbers. Whereas, Iran is working at full production capacity, or could work at full production capacity very quickly in an unsanctioned scenario. So I think that OPEC will be keeping a very close eye on what happens in Tehran, and trying to understand, if those barrels were able to come back to market, what that would mean for the cartel.
Thanks.
This is so good. And I'm just having kind of a thought that, a lot of airline pilots on this call, if you think back to the 2008 through 2013 era, when oil was floating around that $100 a barrel mark, airlines were not in a good place there. So while it's kind of funny to be talking about, us as oil and gas investors now wanting higher oil prices, while at the same time, that definitely puts pressure on Section 6 negotiating cycles and profitability of airlines. But I'd love to turn this over to Q&A. Schreiner, we've got about 5 more minutes with you before you need to jump. Anybody that has questions, please feel free to throw them in the chat, or just unmute and fire away. We got 47 people on the call. I love it. Anyone with questions? Maybe we're kind of hitting it. That's good. Tell you what, I'm going to do something. I got an image in the chat here that I'd like to discuss. Mark, you sent this to me from an article on LinkedIn. It kind of shows the interplay between reserves and production, and that reserves, just because Venezuela has massive reserves on par with Saudi, it does not mean that they're going to produce. And so, Schreiner, I'd love to get your thoughts on this graph that I just dropped into the chat.
Yeah, and I think there's been a lot of serious reexamination about that sort of 300 billion barrel reserve figure, and I think there's a lot of academic discussion about the rigor of that number, and how real that number is. And if you kind of go back into the history of that number, when that started kind of being bandied about, that was sort of put out by the Chavistas, by Chavez himself, when oil was at that $100 kind of mark. And so, at Rystad Energy, we've taken a very rigorous analytical approach to trying to understand what are the true recoverable reserves of Venezuela. And actually, we think it's quite a bit less than that 300 billion. We're looking at, in an $80 real scenario, that the recoverable reserves are probably closer to 60 billion. Now, having said that, there is a question about, what are the reserves of Saudi Arabia, really? It's very hard to get an empirical answer to that. Same with Russia, same with a lot of countries out there on Earth. The Saudis will never publicly disclose what the true reserves numbers are. That was the big issue when they thought about doing some sort of IPO with Saudi Aramco, was that they would have to give up that state secret of what the reserves really are. So I think reserves in general, when we're talking about this, difficult to ascertain what the true story is. The Venezuelan reserves, most probably much lower than that 300 billion barrels, closer to that 60 billion barrels. Depending on the price in which you're operating. The other, I think, thing with Venezuela to think about is the break-even cost, specifically in the Faja de Orinoco, which is the heavy oil belt there. And what we're seeing actually is that the break-even cost, the cost to produce a barrel, how much you need to just break even on that 1 barrel of production, right now is for current production, is kind of in the $30 range. But actually, for new incremental production, we see it climbing higher on the y-axis in terms of price. So actually, many of these barrels are in the $70 to $80 range when you're talking about full cycle break even. So that again makes these barrels a little bit less interesting, in the sense that the break even is higher than what you're seeing in places like offshore Brazil, where you have break evens in the 20s, Guyana, break evens in the 20s and 30s. So, yeah, I think there's a lot of questions around the reserves and how economical are these reserves at what price point. And yeah, I think I'll leave you guys with that. Apologies because I have to jump to another call just now, but really appreciated the opportunity to speak. And for your other investors, yourself, we're very happy to, continue these conversations and to expose some of our underlying assumptions in the thoughts that I've shared with you today.
Thank you, Schreiner. We have a few questions in the chat that maybe we can hit on a future episode or a podcast or something like that. So we appreciate you joining us. Thank you so much.
Thank you. Goodbye.
Thanks, Schreiner.
That was a super fun conversation. Thanks everyone for joining live. We'll obviously publish the replay of this. Mark, I don't know if you're comfortable, touching on Paul's question. Do you think the energy markets will remain investable with this much extra supply on the sidelines? I think that Schreiner's pointing to break-even prices kind of answers that. We're seeing in our portfolio from last year that our break-evens are between $35 and $40 a barrel. We're currently sitting at 62, so we're feeling very comfortable about that. And then, Mark, I don't know if you want to speak to that as well as the recent price action in gas based on the demand from AI.
Well, a couple of things. First of all, the rig count has gone down in the last couple of years. So normally when that comes down, over a long period of time like it has, the costs go down with it. So even though the oil price is low, I expect that break-even cost to stay somewhere where it is now. I don't see it going up. It may even come down a little bit. There's also some transition from, as I've been thinking for a while, from oil to gas. So a lot of people are moving over to gas. The number of gas rigs has picked up, and a lot of that has to do with Gulf Coast LNG and AI. On the other hand,
talk a little bit about the Gulf Coast before you move on. Can you talk a little bit more about the Gulf Coast LNG facilities, because this is a really, really important thing to understand for understanding the long-term potential trends of natural gas?
So if you just go back 15 or 20 years, there were very few LNG facilities on the Gulf Coast, and they were built to import natural gas because we didn't think we were going to have enough. Well, once the shale revolution hit, they decided to transform some of those and turn them into export facilities. And at the same time, I think there are 5 that are under construction right now, and another 4 or 5 being planned. So, and that's all because of the shale revolution. So that's just a great, economic tool that the United States has to be able to export gas all over the world. And the price that they get, if you convert it back to an MCF, is 4 or 5 times what they would receive here in the US. So it's very economic, but these are also 5 to 15-year projects that require billions of dollars. And that's good for the Gulf Coast gas business and some of the places that will be investing, like North Louisiana, Haynesville, because they need long-term gas to do that. So it's not dependent upon the weather anymore. Although there are some fluctuations, it's more of a long-term play. And I think that's great for us. And back to the oil price for a minute as well. There's always good and bad with anything that happens in the oil and gas price. Lower oil pricing might give us opportunity to purchase more assets because, operators aren't able to fund their own drilling program. So there's not, we'll be evaluating each deal, very closely this year, but it's not necessarily bad that oil price has gone lower.
Yeah. And why is that?
Because we would be able to purchase oil assets cheaper since the price is lower. A lot of people run their economics on, the NYMEX futures. Go to any of these websites that show, what you can hedge or guarantee a future barrel at, and that's how they decide to buy or sell something. And that, that benchmark has gone down over the last year.
Gabe's asking, is the rig count going down because we can get more oil per rig from longer laterals, or is it just less investment in explorations?
The amount of available acreage has gone down for sure, but there's also been, back to the, investability of oil and gas right now, there's also been a huge consolidation in the industry, companies buying each other. And so if company X buys company Y and they had 10 rigs running each, they may not keep all 20, they may go down to 15. and still keep the rigs running in the play, and those wells are all still going to get drilled. It just maybe not be so aggressive. So not necessarily a bad thing there either. But we are drilling longer wells, which can make us not have to drill so many in the future. But that's good. That means we get more for the money when we drill one.
Right. James had a great point. Low oil prices are great tailwinds for a growing economy and for greater margins for many industries. Many investment assets will benefit from low oil. This is true. Just not energy investments. Sounds like now is a good time to be somewhere else as an investor until oil comes around again. Two ways to look at it. Number one, energy prices are volatile. And like Schreiner said, if we could predict them, we'd be we'd be in a different business, right? So this is long-term investing and something that we just are personally, I'm allocating to. This is not where I'm putting my entire net worth, but there's some great tax benefits that come along with it, some great cash flow, and it's something that I want to allocate a portion of my portfolio to. So while we don't even have an energy fund open currently, we're keeping our eyes on it and we're gearing up for a launch sometime this year. The other side of it is that while prices are low, we are getting great bid prices on new assets, as Mark, you can attest, because we're already looking at assets to put into the 2026 forthcoming fund.
So there was a question about what price
please.
assumptions will there be, and the ones for our fund last year were obviously higher than the current pricing. So to answer that question, yes, we will be having lower oil price assumptions, but higher gas price assumptions in our modeling for these next couple of months, unless something really changes. But we'll also be looking at some gas assets, and we were mostly oil in last year's fund. So we'll definitely be looking at opportunities for both.
We did also base our underwriting for last year's fund on $65 a barrel oil and $3.50 gas. And oil just came back up to 62, so very close to pro forma. Initial data readings, which we're going to be sending out as soon as next week. Big update on the Iron Horse Energy Fund is forthcoming. It looks like production numbers on the first few wells are ahead of our initial projections, so that should balance out nicely. And we are currently sitting above our forecasted oil price, our gas price. We underwrote at 350. Mark, do you know what we are at today?
I have to look real quick. Hold on.
No problem. In the meantime, Paul's asking, will gas or other products ever weigh more heavily than crude? Yes. Good question, Paul. Potentially. We're looking at weighting our 2026 fund much heavier on gas because of the AI boom. And that's really the way that we see a safe way to play the AI boom. We don't want to be left holding the bag if the whole thing collapses, as you've seen a lot in the news about the bubble that's starting to form in AI, and we don't want to be left holding the bag, investing in data centers and things like that. If somebody figures out how to build chips that don't need as much cooling or as much space, we'd rather just supply the fuel.
Gas price is 308 today.
Oh, it's lower. Okay.
Yeah,
It was sitting up in the fours last week. So again, a lot of volatility. And again, that's what we try to convey to investors, that, this is a long-term hold. Yes, the majority of the returns are going to come in the next 24 months, but we're going to be holding these assets for the next 5 to 7 years. And so this is, you really do have to have a little bit of a stomach for energy investing versus real estate, which can be very, very calm. And oftentimes when investors jump into a real estate deal with us who haven't done real estate before, they've been in the stock market, they are calling us a week later saying, okay, what's happening? It's like nothing. That's the idea. Tenants are paying their rent and that's it. We'll have an update for you next quarter. Energy has more volatility. So you just have to be a little bit ready for that. And again, we have absolutely no way of knowing what vintages will perform better than others because we have absolutely no control over, the energy price volatility. But hopefully the conversation with Schreiner was informative and put some people at ease in terms of the geopolitical things that are going on right now, especially with Venezuela. Paul, real estate usually goes up in value over time. How do you calculate the future values of wells or minerals? Good question. Mark, you want to take that one or you want me to?
I'll take it. So a majority of the value in the wells that we're going to be participating in is up front. So, we are doing, it's one of the reasons I'm on board, a very sophisticated analysis of each well and how much it costs and what it's going to produce, what are its expenses, taxes, and that type of thing. And that goes into our evaluation when we look at getting in a deal. But keep in mind that I think we looked at this on a prior call, but 30 to 40% of the value of the well comes out in the first 2 years. The current production of a well is what drives most of that value. 5 to 10 years down the road, it's worth maybe 5% of its original value.
Yeah, which is why we have communicated in the past that I love having this asset class in my personal portfolio because it balances real estate very nicely. Real estate goes up over time. An oil and gas asset, if you invest $100,000 in it, at the end of 5 to 7 years, it's worth significantly less than that initial 100,000, but you're getting that cash flow back very quickly. So very good, attractive tax benefits, high upfront cash flow, which means higher IRRs. And you also aren't dealing with recapture tax down the road like you are with real estate, where you're paying recapture and capital gains. That balances a real estate deal very nicely. That maybe you're investing 100K in a real estate deal and you might see zero cash flow over the next few years if it's a development deal, or just a trickle of cash flow if it's a value add multifamily or a self-storage facility or something like that. And so they just balance each other nicely. So we're certainly not saying, hey, oil and gas is the end all be all, but it's definitely an asset class that we are committed to and we're excited about for the future. I'm going to field one more question on oil and gas, and then we're going to switch gears to everything else. And this is again from Paul. Thanks for all the questions, Paul. Is there any liability for future environmental damage for well owners, past and present? We covered this extensively during the webinar series and the Q&A in Iron Horse. I would encourage you to go back to the Q&A for Iron Horse and look at that. We'll be talking about this ad nauseum in our upcoming deal later in Q2 of this year. But in order to get those big upfront IDCs, technically you need unlimited liability. You have to invest via your personal name. In reality, there are insurance policies in place. We own a very small minority interest in each one of these wells, anywhere between 2 and 5% usually. We've capped our maximum interest in any one well at 10%. So if there was some sort of an environmental disaster, first of all, we own a minority stake. Second, we have a contingency fund. Third, the plaintiffs that are going after the oil company for damages, they're going to target EOG, that is a multi-billion-dollar company. They're not going to find Paul's phone number and start calling you and asking you for money. So there are many, many layers of protection, even though it is technically unlimited liability. So thanks for dropping that in the chat, Brittany. That's the Iron Horse Energy Fund Q&A. There's some great information in there. With that, I want to switch gears. We've talked a lot about oil and gas today, which is great. With all the stuff in the news about it, we wanted to get ahead of that and provide as much information as we could. But with that, we want to switch gears. I had a question. Will the private credit fund remain open for a considerable amount of time? Yes, we're planning on being open for the private credit fund for the next decade. So that will continue to sit on the portal. We are clipping about a 10.5% return to investors currently. There is a 60-day deployment period. So if you invest in it, just keep in mind that your funds do not accrue for 60 days. But after that, they do. It's quarterly distributions. And our investors in the fund have been very happy so far. We're happy so far. It's a really great fund. And as it grows, it just becomes more and more and more diversified. So we love that fund, and it'll be open for the next decade. Had another question here. What other asset class investments is Turbine looking at for 2026? John, do you want to jump in here and talk about what we're currently looking at? We're going to be in Atlanta and Jacksonville in a week, touring a couple of assets. John, I'll hand the mic to you. What do we got in the pipeline?
Yeah, sounds good. Thanks, Tait. Like you mentioned, we are hitting the road here next week to look at a couple different operators. One I'll just speak to that we're really excited about is senior living. And
Yep.
if we haven't talked too much about it, but for those of you who have researched the silver tsunami and really how much need is out there, and just just a real quick thing on the senior housing. If you think about the demand it's mathematically locked in. The amount of people that are turning 65. I mean, the rate is, I mean, I don't have the exact number, but it's, like 10,000 a day or something crazy. And so anyways, we're very bullish on it. And we've been treading lightly with trying to find a good operator, because that's the key to senior housing. That's the ones that we've seen failing, are when you have an operator who's unable to perform. So we're going to go down to Jacksonville, and we're going to be looking at a couple of the homes that of assisted living, memory care, with a known operator who's done nothing but had success. So we're very excited for that, and we feel like it's time to move. Another asset class that we're looking at, hopefully launching, is going to be in the development side of the house. We know there's a lot of opportunity there. It's kind of just like we've heard from Aspen with the industrial, the land fund. There's just been a lot of building has really slowed down, or even dropped off a cliff in the last couple of years. So we're hoping to jump on the tailwinds on the development side as well.
Thanks, John. Yeah, senior living is coming right behind the industrial fund. And actually, you were asking what other investments might be suited for an SDIRA. Just to give a few highlights on what the senior living deal looks like, it is a $100 million development, 2/3 independent living, 1/3 assisted living, and I believe a small memory care unit. This is a development that sits inside of a Rainier master plan development. This land was scooped up by this group during COVID, when everybody was running for the hills because vacancy was through the roof in senior housing. But they had the fortitude to buy this parcel during COVID, got a great deal on it, and they've got permits in hand. It's fully entitled, and the site grading has already been completed. They're going to start going vertical here in the next couple of weeks, and we've taken down the last about $10 million of equity in this deal. We're really excited about it. It's a beautiful build, really nice architecture, and the operator on this deal is fourth generation senior housing, senior living property manager. So ingrained in the family, just very, very high integrity. And in any case, we're looking forward to going down there and getting some time with that team. That is going to be a 4 to 7 year hold. It's ground up, just like the Industrial Growth Fund. It's great for an IRA because you're not going to get a whole lot of tax benefits, because right now it's just land. There's no structure. We can't depreciate it. You're not going to get any big loss on your K1. So it's a perfect one for your SDIRA. It has very similar IRR and return metrics to the growth fund. It's just the growth fund if you got a little bit shorter of a time horizon, you don't want to be in a deal for 4 to 7 years. The growth fund does have some opportunities for exits along the way. There are parcels of land that might be sold off. There are refinances that might happen. Industrial takes a heck of a lot less time to build than, basically a multifamily building with some hospital components built in. That's a much more complicated build, and so it takes a longer time. So if you're looking for a little bit of a quicker return of capital, the industrial growth fund's probably more for you, versus the senior living is truly patient capital, because it's a beautiful build, but it is going to take some time. But both of those are very similar in terms of tax benefit and suitability for IRA. Brandon had a great question. Do I have to file returns in the states that I participate in as an LP deals, or just in my state of residence? We file composite returns. We insist that our CPA firms file composite returns on behalf of our investors. What that means is that we pay any state taxes that are due at the fund level, and you do not have to go and file in all these different states. Private credit fund is a perfect example. There are assets in, I think, 3 states currently. If we did not do a composite return, you would have to file a tax return in all of those states. You do not have to do that. And same thing with the Iron Horse Energy Fund, same thing with the Sunrise Infinity Fund. We take care of those composite returns for you so that it's taken care of. You only have to file in your state of residence. we try to make it as easy as possible for you. Just talking in terms of, I know everyone's curious about other deals on the horizon. We have some very exciting developments within our Stealth Point fund. Stealth Point was our VC deal that we did under the Skunkworks banner earlier this year. For those of you that are not in that fund, one of the companies is going through another round with a very prominent biotech VC, and we have the opportunity to do a sidecar investment with that. We're really excited. I mean, this is like, it could be huge. So some really cool developments with that. That sidecar investment is only open to the existing LPs within that fund, but we are heavy in talks about Fund 2 for Stealth Point. That will be launching sometime in Q2. But the unique thing is that instead of coming in as the 11th hour capital like we did last time, we'll be coming in a little bit earlier in the show. And this VC fund works a little bit differently than a typical real estate deal. If you want to commit $100,000 in most any other deal, you got to submit $100,000. If you want to come into Stealth Point Fund 2, you actually only need 5% per quarter on your commitment. So we're going to call down capital on a quarterly basis. And so if you say, all right, I want to commit 100K to Stealth Point Fund 2, great, we have your commitment. And at the end of each quarter, we'll say, hey, you've got $5,000 due. And that cash is slowly deployed into a basket of early stage startups. Obviously a very high risk profile, but high potential return as well. So we've got that coming. We've got industrial and the senior living deals, which we absolutely love. The industrial deal, I can't say enough good things about it. We have a track record of success building industrial with this group, and it's just a fantastic deal. And then with the tailwinds on senior living, we're just really excited to have found a partnership that works for us. So we've got those. The oil and gas deal for 2026 is coming sometime in Q2. That'll be open throughout the end of the year. We're going to have some sort of a system of rewarding earlier investors. We haven't quite figured that out yet, but it's coming. That'll run through the end of the year with the same tax benefits as Iron Horse last year. By the way, on Iron Horse, we've received word that we should be north of 90% tax write-off on that deal. So on 100,000, you should have more than a $90,000 write-off on that deal, which is fantastic. Brandon says, too many compelling deals coming. I'm going to have to start driving for Uber. I hear you. I know sometimes we're it's a barrage, but you got to pick and choose. And let's see, what else do we have coming? John, what else do we have in the pipeline? Potentially some mobile home park stuff.
Yep. Yeah. We are in talks with Reef some more. So all the Reef fans who are out there, we're hopefully going to get out there. They have a couple properties this spring that we want to go look at, and keeping our fingers crossed that that's going to be one for us to launch as well.
Good stuff. We may also have some follow-on multifamily opportunities later this year, similar to Azara. We loved the Azara deal. We love the Phoenix market. It's completely beat up because of the rise in interest rates and the oversupply of construction there, and so prices are just in the trash in Phoenix, which is challenging for some of the investments that we bought back in 2022, candidly. But that's good news for investors today because we're scooping up assets at just a great basis. And it would be in partnership with our friends over at Sunrise for the Fund 5. I was actually on the phone with them yesterday chatting about we want to see the initial assets that are going into the funds, that we can dig into those and see how we like them, and then sort of what economics we can negotiate for our group on that. Great question from Gabe. When is Azara expected to pay out? First quarterly distribution should be in February. We didn't close until November. There was some, I won't say issues, but it was challenging getting that loan across the finish line. The lending environment's very tight right now, and so closing got pushed back until about mid-November. So our first full month of operation was in December. So I believe February or March, but we raised slightly more equity than we had planned. So it's a slightly lower loan to value. And we locked at, I believe, 5.2, John.
Yep, yeah, which was lower than we thought. We were thinking it was going to be in that 5.6 range.
Yeah, we had underwritten the project at 5.5 or 5.6. So stronger cash flow than what was originally anticipated. But February or March, and that we like monthly distributions, but that one's going to be quarterly. What else we got? Thanks for all the questions, guys. This is fantastic.
I did want to selfishly do a plug for our investors who are on here so you get to hear about it first. Tait and Mark are actually going to be headed to NAPE next month. And then myself and TJ will be headed to BEC in the same time zone. So February, around February 18th in Salt Lake City. NAPE will be in Houston, Texas, and we will be hosting a happy hour for our investors. So I know you folks may have already closed your bid for next month, but if you have a layover, you can finagle a fly-in to join us. We'll be posting out some information on our calendar, and we'll be sending out some emails to encourage you folks to RSVP. But we would love to see you folks live there in Salt Lake City as well as in Houston.
Thanks, Brittany. And then 2 more questions on Reef and Stealth Point. So Elisa, update on Reef. Actually, we just got word this morning that there is a $1 million discretionary distribution happening for Reef. Obviously, that's not a huge distribution when you consider $150 million worth of capital, but there is going to be a small distribution on Reef early. Darren's asking potential return, early return of some capital for Stealth Point. Not currently. We're not, that was a 5-year hold to get the QSBS to avoid capital gains tax on things that are within the portfolio. So not currently. However, the sidecar on Ramona is extremely exciting. And we think that investment in that sidecar and in Ramona will exit in the next 2 to 3 years. So a sidecar investment in Ramona will not enjoy any QSBS tax treatment because of the potential quick sale of that company. Obviously, a sale of Ramona would go back into the main fund as well and potentially contribute to a distribution from the main fund. However, I don't want to speak too soon because there could be a loss of capital event on one of the other 8 portfolio companies within the fund. A sidecar investment in Ramona is very likely to return capital in the next 2 to 3 years at a very healthy multiple. But of course, that's not without risk. So you've got an email in your inbox about that. Brandon's asking, would you recommend diversifying low or no cash flow deals and cash flow deals to take advantage of paper losses sooner instead of carrying them forward from year to year? Not tax, legal, or investment advice, but yeah, I love mixing my portfolio with, I've got money in the private credit fund, and that's sort of my foundation, and very, very low risk. It just pays or compounds on a quarterly basis. And then I also invest over in the Stealth Point fund, which is extremely high risk, extremely high potential return. And so I like blending all of those things. And of course, it also depends on your tax situation of what's happening outside of your syndication investments for a particular year. We had some investors who were doing some Roth chunking this year, and so they invested heavily in the oil and gas fund because they wanted to convert $200,000-$300,000 worth of traditional money over to Roth, and they needed to get their AGI back down. There might be a property that you sell and don't turn 1031 exchange. You might have a multiple $100,000 or $1 million capital gain that you need to offset. These are things that you should talk to your CPA about, and you can use your LP investments as tools to control your tax situation. But if you're just looking at the syndication bucket in the LP investing bucket, I would say that's a great strategy is to mix and match. Absolutely. John, you got anything to add on that, or even Darren Hobbs, if you want to unmute? You're a very astute investor. What would you say to that? Darren, are you driving, or maybe you're flying?
I am not. No, I'm definitely not flying. Flying and watching at the same time would be bad. Yeah, I agree. I personally, I do all of that. I want some of the tax benefits up front, and then others I want stability and cash coming in. But I'm closer to retirement than a lot of the guys. So I want that proven cash flow and consistent payments to cover potential, like you're talking about, these potential projects, the industrial fund or the stealth point that are going to take several years to come to fruition.
Thanks, Darren. Appreciate the feedback. Josh, update on Aspen 2. Yes, it's coming and should be published today, actually. Thank you so much. That went fast. Thanks for joining, everyone. This was a blast. Great showing today. Really appreciate everyone's time. Thanks for showing up live. We ended up recording the whole thing because this has just been such good content. So we'll push this out on a replay, both on Vimeo as well as the private podcast. So thanks again. Reach out to us with any questions, and thanks for being with us in 2026. Cheers, everyone.